Correlation of economic parameters with stock market. Understanding the correlation of economic indicators with the stock market is crucial for investors, traders, and analysts. Here's an explanation of how some key economic indicators are typically correlated with the stock market. A. Gross domestic product, GDP, positive. Generally, a growing economy, as indicated by rising GDP, is associated with a positive stock market. Strong economic performance often translates into higher corporate profits and investor confidence. Though Index of Industrial Production, IIP, positive. Increasing industrial production is often linked to economic expansion, which can positively impact corporate earnings and, consequently, stock market performance. Teen. Purchasing Managers Index, PMI, positive. A PMI above 50 signals economic expansion, often correlating with a rising stock market. A PMI below 50 may indicate contraction and could lead to market declines. 4. Inflation, neutral to negative. Moderate inflation is generally positive for stocks, indicating a healthy economy. However, high inflation can erode purchasing power and reduce corporate profits, potentially impacting the stock market negatively. 5. Cash Reserve Ratio, CRR, neutral to negative. A higher CRR reduces the amount of money banks can lend, potentially impacting liquidity in the financial system. This may lead to higher borrowing costs, which can have a negative impact on the stock market. 6. Repo rate, neutral to negative. Changes in the repo rate influence borrowing costs. While a rate cut can stimulate economic activity and benefit stocks, unexpectedly high rates may increase borrowing costs for companies, potentially affecting stock prices negatively. 7. Unemployment rate, negative. High unemployment rates may lead to reduced consumer spending, which can negatively impact corporate earnings and stock prices. 8. Consumer Price Index, CPI, neutral. Moderate inflation, as reflected in the CPI, is generally positive for stocks. However, extremely high or low inflation levels may have negative implications. 9. Trade balance, positive. A positive trade balance, exports greater than imports, can contribute to economic growth, potentially benefiting the stock market. Thus, Consumer Confidence Index, positive. High consumer confidence is often associated with increased spending and economic growth, which can positively impact the stock market. 11. Housing starts, positive. Increasing housing starts may indicate economic growth and can benefit industries related to construction, potentially impacting the stock market positively. 12. Leading economic indicators, LE, positive. Leading indicators, as the name suggests, can provide insights into future economic trends. Positive LE trends are often associated with a bullish stock market. Considerations for understanding correlations. Economic indicators are interconnected, and their impact on the stock market is often cumulative. Investors should consider the broader economic picture. Market reactions are also influenced by expectations. If economic indicators meet or exceed expectations, the impact on the stock market may be less pronounced. Global economic conditions and geopolitical events can also influence stock markets. Consider the international context when analyzing economic indicators. Time lag. The impact of economic indicators may not be immediate. Investors should be aware of potential time lags between economic data releases and market reactions. Qualitative factors such as corporate governance, geopolitical stability, and technological advancements also play a crucial role in market movements. Investor sentiment and psychological factors can sometimes override economic fundamentals in the short term. Diversifying investments across different sectors and asset classes can help manage risks associated with economic fluctuations. Economic conditions and correlations can change. Regularly monitoring economic indicators and staying informed is essential for making well-informed investment decisions. Understanding the correlation between economic indicators and the stock market requires a nuanced approach, considering the dynamic nature of financial markets and the multifaceted impact of economic factors. Investors should integrate economic analysis into their overall investment strategy while recognizing the complex interplay of various influences on stock market movements. Subscribe to our channel for more updates.